Trading securities is a type of debt investment or debt instrument, and it is a current asset because trading securities are securities that are actively traded on the market for profit. So, trading securities are actively bought and sold on the market for profit, which is why it's classified as a current asset. You're not looking to hold this security for longer than a year. Instead, you're trying to, you know, purchase the security and turn it over for a profit within a short period of time. Now, when it comes to these type of securities, there are some adjustments that needs to be made on the balance sheet and also the income statement. And it's because since you're actively are buying and selling these type of securities for a profit, you will have to present the value of those securities on a periodic basis, like the updated value of those securities on a periodic basis. So, as you can see here, for example, the cost of the security was $10,000. We're going to say that you purchased that on March 1st. So, you purchased a debt security for $10,000 at the beginning of the month. At the end of the month, so at the end of March, that security was worth or valued at $12,000. So since you are actively buying and selling these type of securities for profit, you're going to have to reflect the increase or decrease in value on those securities in your financial statements. So as you can see here, there's a $2,000 increase on this type of security. So to reflect this in the financial statements, we're going to go ahead and put together the general journal. And I'm only going to record the entry that needs to be made reflecting the increase in value on the security. I'm not going to record the entry that was made on March 1st, reflecting the initial cost or purchase of the security. So the date is going to be March 31st. And so we see that the fair value or the cost was $10,000. The fair value was $12,000 as of the end of the month, which means that that's a $2,000 difference. And the account that's going to be debited is going to be fair value adjustment dash trading. It's going to be debited for $2,000. So that's going to increase the value on that security. And this $2,000 is going to be reflected in the balance sheet specifically as a current asset. Now, the other account that's affected is going to be called unrealized gain dash income for that same amount, $2,000. This is going to be reflected in the income statement, specifically in the other revenues and gains section. Now it is unrealized. All right. And the reason why this is an unrealized gain is because you didn't sell the security yet, but you have to report or recognize the increase in value, which is going to be a gain, but it is not realized yet because you didn't sell the security. So maybe you're planning on holding the security for another month or two, and the value can fluctuate. You can go up and down. You know, it can go back down or go from 12,000 to 11,000. And then from 11,000, it can go back up to, let's just say 13,000. But either way, whenever at the end of the period, whenever that period comes, you have to make sure that you are reflecting the current value of that security. All right. So again, the fair value adjustment account here, that's going to affect the balance sheet. And then the unrealized gain income is going to affect the income statement.